welcome to Morning Markets from True Potential. Today there's certainly a number of trends and themes to discuss from markets yesterday. A day that was very much focused on the central bank of the US, the Federal Reserve, and how they would assess the current monetary conditions, the economic conditions, but also their view on what had been happening in the sovereign bond market. Remember, we've been discussing over the past number of weeks the very significant change that we've seen within sovereign bond markets, with yields continuing to move higher. That was very much and quite interestingly the case yesterday before we had the announcement from the Federal Reserve, and we did see sovereign bonds for the US, Europe, UK move out ahead of the central bank meeting. And this was, I think, something quite unusual. We normally see relatively subdued bond markets running into the monetary policy announcement. So that was something that certainly was front and centre of mind yesterday, and we did see that playing out in equity markets, where we did see that bit of rotation. Also, we did see that within sovereign bond markets across the piece, with looking at the UK, the 10-year yield moving out 5 basis points to 0.83, and then across Europe, sovereign bonds out 1 to sort of 7 basis points. The US market itself, the US 10-year was weaker as well, out to 167, ahead of the Fed meeting. And this gives quite an interesting market dynamic from an equity context in the US yesterday, where we did see, as we have seen and has been the historical pattern, those more growth-orientated areas of the market selling off a little bit into that. So the likes of the Nasdaq futures were indicating Nasdaq was going to open down about 1%, but then we can look at how Nasdaq closed. It closed up 0.4% or thereabouts. So that is a reversal, and that reversal was very much triggered by what we heard from the Federal Reserve. And just to go into that in a little bit of detail, so everybody's aware of what was said, really quite material changes to some of the forecasts that the Federal Reserve have been working with for the US economy. And it very much reflects the comments that we've been making in recent months about the relative strength of economic data coming out of the US, the speed of the recovery that we're seeing there. And where does that come about, and where's evident in the data that the Fed provided yesterday? Well, their expectation for GDP growth for 2021 is now 6.5%. That's revised up from their December meeting of 4.2%. So quite a step change there. Remember that there's a number of factors that are influencing that. Speed of vaccine rollouts, the change in dynamics that we've seen in terms of the fiscal support package, the one that has come through post the election of President Biden. That wasn't incorporated in their previous expectations. The other change is further improvement in the unemployment rate, so unemployment falling to 4.5% by the end of the year from previous expectations of 5%. Then turning to the real sort of nub of the issues, what's happening in inflation, what's their expectation for inflation, and hence how are they thinking about monetary policy. They, i.e. the Fed, focus in on personal consumption expenditure, PCE inflation, and their expectation there for this year is that it will come in at 2.4 versus 1.8. And then stripping out the food and energy, so that more volatile components of PCE inflation, we see that they expect 2.2% versus 1.8%. So a tick up in inflation to be expected given the dynamics that we're talking about, growth, unemployment coming down, what we're seeing in terms of pricing in the survey data as well. But over the longer term, they see that blip in inflation, if you will, coming up as we annualise the COVID-19 impacts on inflation. But then inflation trending back towards 2%. And if we remember, they do have an average inflation target of 2%, so above and below, but trending back to that level. So no step change in the inflationary environment. They also reiterated their continued bond buying program, so the quantitative easing program, continuing that, 120 billion per month. Now then, the crucial part of this all comes together then as to what was the expectation did the Fed give us in terms of interest rates, the trajectory of interest rates, and really there was no change there. And this goes back to the dot plot, and I think you can see those on the screen at the moment. We've just contrasted the dot plot from the meeting in December with the one from March. And what can you see there? Really, that the majority of voting members within the Fed don't see rate changes until 2024. We've seen a number of voting members suggest there's a possibility of rate increases before that, and you can see that by the distribution of dots above that median line. But really, the majority of the committee don't see the need to move interest rates, and that was important, I think, from a market sentiment perspective, and we saw that then in that turnaround in markets. We saw the US 10-year yield come in a little bit, and we saw that stronger performance from some of the more growth-orientated areas of the market. I think really there's one sentence within the Fed commentary that sort of sums up the challenges, but also the opportunities, and it's really that the path of the economy will depend significantly on the course of the virus, including progress in vaccinations. Ongoing public health crisis continues to weigh on economic activity, employment and inflation, and poses considerable risks to the economic outlook. So I think that really gives you the encapsulation of the Fed's perspective. They will be very accommodative for a number of months to come. Now, just looking at how that has played out then in Asian markets, we've seen Asian markets react positively, a good performance there. But what is, I think, really interesting this morning is that we're seeing the sovereign bond markets in a number of markets continuing to move out a little bit, and indeed very much so within the US. The US 10-year continues to trade through in Asia, and that has moved out above 1.7% this morning. So quite notable, that movement this morning when the US market's not open. So that's something to certainly watch, and that is having an influence on the futures markets. As we'd expect, that's a negative for growth. Nasdaq futures do look a bit weaker as a result of that move. Looking to the day ahead, again, very much about central banks. We get the Bank of England later today, and then this evening tonight we'll have the Bank of Japan as well. Two other important meetings through the course of this week, and we'll comment on both of those tomorrow. Many thanks, and I look forward again to seeing you tomorrow. Thank you.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.